Are you a passive real estate investor looking to pick the best sponsors and the best deals to invest in? In this video, I'm going to speak about the 8 critical questions you must ask your sponsor before you do business. So the first question that you should be asking as a passive investor is, what is the general partner's track record? And there's a couple of sub-questions that fall under that. The first one is, what type of assets have they been specializing in versus the type of asset they're presenting to you now. So for example, if they've never done ground up development before and everything was value add strategies on residential properties, and now they're going to do an office building from the ground up and they don't have experience in that, that's something that should raise a red flag and you should look a little further into. So asset class, previous experience versus what they're focusing on now is relevant, because just because somebody was successful in one sector of real estate, that doesn't always equate to success in another. The second sub-question is, whose track record are we talking about? And a common practice in the real estate syndication space is a lot of newer operators that come into the market, they don't have a big established track record, so they will partner with larger syndicators that have been around for 10 years, 20 years, that have a proven track record, and they will give a portion of the general partnership to those bigger syndication groups so they can advertise their brand, track record, and their likeness. However, the big question is, who's actually running the deal? Is it the people's track record that's being advertised? Or has there been some type of joint partnership arrangement made where those folks are not actually involved in the day-to-day operation? So you really want to get clear on whose track record and what are they doing within the business. The third bullet point under this is, how many market cycles have they went through? As an example, in 2020, 2021, the cost of money was so low, cap rates were compressing. Almost anybody made money in commercial real estate, whether you executed your business plan or not. However, the question isn't always about whether you can make money during good times. It's how do you weather the storm when things change? And good operators are able to make profits for their investors in down markets and bull markets. So you really want to pay attention to how long they've been in the industry and how they performed in different market cycles as well. And the last bullet point under this is, how many deals did you acquire? How many successful exits did you perform? And what were the results of those transactions? How much profit did you deliver to investors? I would also want to ask, what was the worst deal that was ever done? Why did that deal go wrong? So don't just talk about the great outcomes, but also what were the not so good ones that happened? Elaborate on what happened with those transactions as well. So the next factor we're going to talk about, question number 2, is skin in the game. Now this is a very common term that is used in the industry, and essentially what it's referring to is the amount of capital that the general partner is investing into the project themselves. And typically, the industry standard could be 3%, 5%. That's a normal number. Sometimes people only invest 1%. There are folks that could invest 10%. But there's a big difference, because let's think about what that's saying and what that's indicating. If I'm putting 1% of my capital into the deal and I'm raising 99% of the capital into the deal, there could be multiple reasons for that. One, I just want to make more profit on other people's money and I want to preserve my capital. Another could be they don't have the liquidity to invest more money, or they want to diversify their risk. But when somebody is putting in 5%, 10% of their own equity, 15%, some sponsors even put 20% of their own equity in, it shows how much they believe in the deal and also how well capitalized they are, which give passive investors more peace of mind knowing that the people operating the deal are going to be very, very highly motivated to make sure everything goes according to plan. Question number 3, how are you establishing a local presence? Now, there's a couple of ways that people can achieve this. So one is obviously by being local to that particular area, which is usually the best and safest route because you're there, you're present. You're able to follow up and check in on the property, see what's going on. You're able to establish a network of contractors, service providers, people that you need to team up with, versus being out of state and issues happen on the property. It's hard to jump on a plane, go and fix a problem every time it comes up versus maybe taking a drive for 30 minutes or an hour. So being local is a huge advantage in the real estate game. Now, the way other sponsors and syndicators might achieve this is by partnering with third property management companies or partnering with other syndicators that are going to handle the day-to-day operations of a property. However, if they party with a third-party property management company, there are limitations to that because there's a misalignment of interests. And as we go through this video, I'm going to discuss property management and the questions you need to ask around that. Question number 4, what is your property management strategy? Now, there's typically 2 strategies that are implemented. One is where the sponsor, the general partner, have their own internal property management, meaning that all the people that service the property, the maintenance people, the property manager on site, the leasing agents, they are all under the payroll and under the direct supervision of the people executing on the deal. Now, many investors consider the third-party approach to be a little bit more risky. And the reason being is because a third-party property management's interests are not aligned with the investor interests. As an example, they're usually incentivized based on the top-line revenue, the gross income coming in. You, as the investor, care about the net revenue because that's what's going to drive the value of the property. So it's the income after the expenses. This causes certain issues like not looking out for your money the way you would look out for your money, not shopping vendors an extra time and making sure you get the best pricing. And also, they might have thousands of properties if it's a larger property management company versus a syndicator might have 2-3 projects they're working on. That's their baby, right? They're going to put more attention and more focus versus a big property management company that has a lot of clients, their own policies, and their own workflows. Now, if somebody is using a third-party property management, then you want to ask some other key questions, such as, how long have you had a relationship with them for? How many past deals have you done with them? And how did those deals turn out? If they've never done work with them before, never done business with them before, it's a brand new relationship, that is a risk that you should take into consideration. Another issue with external property management is the red tape. As a personal example, when we first got into the business, we didn't have the scale to have property management in-house, so we would outsource it. However, we realized that we were spending more time and effort managing the property manager than we would have managing the actual property and the employees if we had them in-house. Because every company has different policies, different workflows, and in order to implement your ideas or initiatives, you have to go through multiple people, get approvals, as opposed to having your own employees coming in the morning and saying, hey guys, here's what we're gonna do, let's go and execute. Step number 5, trust but verify. And one of the ways that you can do that is a sponsor is going to provide you with what is called a private placement memorandum, also a company pitch deck, and it's going to have some type of stats on previous deals that they've worked on. So when you take a look through those properties, one of the little tricks that I would do is look at the occupancy. How occupied is the property? So let's say, for example, it says they have a property, it's 100 units and it's 95% occupied. Well, you can verify that. Go on apartments.com, type in the name of the property or some other apartment listing website and see how many units are available in that building. Now, if they're 95% occupied, you shouldn't be able to see more than 5 listed units. If you see 15 or 20 listed units, that's a question that you should ask. Question number 6 is, what's your fee structure? As a passive investor, I would look at this in 2 buckets. Bucket number 1 is upfront fees. And bucket number 2 is upon profit. So the difference here is pretty important. When a syndication is going to charge a lot of fees up front, let's think about that. They haven't made any money yet. Sure, they've done work, but they didn't deliver a result for the investors that are involved. The most common upfront fee would be an acquisition fee and also an ongoing asset management fee. When these fees are being charged, this is for acquiring the property, and yes, the syndicated has done a lot of work to do that, and this is for the ongoing oversight of the property. However, the investor has not yet got a profit. So the back end is usually split anywhere from 80-20, it could be 70-30, sometimes it could even be a 50-50 split, depending on the syndication structure. However, this money upon profit, this is where a passive investor's interest and the syndicator's interests are aligned. Because in order for them to make money, they have to make you money. Now, I want to caveat this by saying there's nothing wrong with people charging an acquisition fee or an asset management fee, because they do need to pay for bills and expenses to run a business. However, when these fees become excessive, 3% acquisition fees, 4% asset management fees, that's where red flags should come up, and you should start asking yourself, why is so much being charged up front? And potentially, maybe you could negotiate a deal where more of it is going to be charged on the back end to create more alignment of interest. Number 7, response time and quality. What do I mean when I say that? You want to really pay attention to how are your questions being addressed and how fast are they being responded to. This gives you an insight into how effectively their organization is structured. For example, if I send an email asking a question and it takes a week to respond, before I'm a client, I'm going to start thinking, what's going to happen when I'm a client? So one of the big things you want to analyze is send a couple of emails, little tests with questions, and then also monitor the quality of the responses, how much effort was put in. You should get a feel for this and really assess their performance before you come on board, because if it's not up to par then, I can almost assure you it's not going to be up to par later. Question number 8, can I see some referrals? Now, a lot of companies will have testimonials on their site, and many times that could suffice, and it shows a person's ability to perform and make investors happy. If you want to take it a step further, it's also reasonable to ask a sponsor to speak with a referral from a past deal. And you can ask that individual, how did the process go? What were some of the challenges that you ran into? What are some of the things that you would have liked to see done differently? Were your K-1s issued on time? Were distributions according to the schedule? And any other questions that may arise. Want to learn more about real estate syndications and the opportunities that are available? Book a call with us. Find out exactly how much you could learn in just a 20-minute time frame.